Okay, I think we're live. Hi everybody. We're here live from the offices of Attract Capital, and I'm with Mr. David Barnett. And
hi everybody.
And my name is Sonia Bellum, and we are here to talk to you today about your tax shield and where did it go? Where did it go, Dave?
That's a good question, Sonia. I don't know. There's a lot of disappearing tax shields in the corporate finance world today. I thought you were going to tell us where did it go.
I know. Well, I wore green. I wore green today because I want Dave to show us where our money is. Show me the money, Dave.
You're wearing it very well today, Sonia.
Thank you.
It's a very appropriate color because we're talking about tax shields, and tax shields are associated with financial savings in a deal and how you're going to set up your deal from a debt and equity standpoint so that you can make more money.
Right, right. And before we start, I want to talk to everybody about this wonderful trip that Dave just went on. He went on a journey halfway around the world.
We did. We were halfway around the world. We went to India to visit our team members in India. We have a marketing team that does a lot of web work for us. It was great to see them. I met their families. We had a lot of dinners. We had a lot of fun. And Bangalore is an incredible place, Sonia. You should put that on your list of places to go.
On the bucket list for everybody, Bangalore. And you did a yoga class too.
I did an authentic yoga class. It was more of a leg lift class, but it was very interesting to sample the yoga culture in another country.
Yeah, that's fantastic. I love the fact that you travel all around the world.
And we stopped in Germany on the way home, and we had a lot of fun talking to German companies. And I'm happy to say that everybody has a very pro-growth outlook in 2018. I think a lot of the people that I met in India, I met a number of other investment bankers and investors. They're all really excited about 2018, and in Germany as well, in Berlin, everybody's very kind of raring for the future. They think that there's a lot of growth available. So it's good to see multiple parts of the world in sync from a growth standpoint so early in 2018.
That's wonderful. Yeah, there are a lot of big businesses in Berlin now, aren't there? Lots of headquarters, lots of international corporations.
There are, Sonia, and there's tremendous entrepreneurial activity. There's a lot of, there's a real can-do spirit. There's a lot of really fast-growing, almost unicorn-like tech companies in Berlin. We think it's a really interesting country, and they need help with figuring out the best way to approach the debt side of their deals, and so we're happy to be there for them.
Well, that's excellent. Great news. So,
yeah.
Dave, let's go back to this tax shield that everybody is so interested in. And can you explain to us a little bit about what's going on with the new laws and regulations?
Well, I think everybody in the deal world probably knows, so I'm not going to rehash it down to the nth degree, but the new tax reform that was passed in late December, it essentially caps the amount of interest deductibility that a business has. And that's a pretty important development, Sonia, because historically, interest expense, if you were a business and you had a loan, you could deduct every single cent of your interest expense that you had on that loan. And it was always kind of a major, accepted thing that, okay, well, if you were paying 6% for your interest expense because you can write it off, you were really only effectively paying 4%. So it was in the eyes of people that are buying companies and are growing companies, it was always a preferred tax-advantaged way to go as opposed to raising equity. So if you can raise debt, it was better from a tax standpoint because equity payments weren't deductible. So that has changed now, and there's a bit of a lid on that.
Okay, can you go into more detail about what you mean?
So what the new tax reform says that it basically says that you cannot deduct interest expense that's greater than 30% of your EBITDA, okay, plus any interest income, plus any warehouse interest expense. And warehouse interest expense is typically a line of credit that is used by auto dealers and other companies that have to finance their equipment. So it's really 30% of your EBITDA, your interest expense minus your interest income, and plus your warehousing expense can't exceed 30% of your EBITDA. So before, it was unlimited. It could have been 50% of your EBITDA, it could have been 70% of your EBITDA, so they're taking it down. So what that means is that if you currently have interest expense, that calculation, we'll just call it that calculation, if you have interest expense of 50%, and it's only at 30%, 20%, that difference is not deductible. That's what that means.
Okay. So are there exceptions, though, to this?
Well, there are exceptions. So it did They did carve out businesses that have gross revenue, average gross revenue of under $25 million.
Okay.
So that's really good for middle market companies if you fall beneath that level. So you can continue to deduct 100% of your interest, which is really positive.
Okay.
The other thing that they accepted, Sonia, was real property. So if you're in a real estate business, if you're acquiring, if you're redeveloping, if you're managing real estate, that is also exempted. So smaller businesses under 25 million in revenue, real property businesses are also exempted. There's also other special businesses that are exempted. Farms are exempted, regulated gas distribution, regulated utilities, as well as financial trading companies. So some of these, when I read the code, Sonia, a lot of it was language that wasn't that specific. It was kind of general. So it almost seems like there were some old language used to describe general classes of companies. I would almost expect there to be some clarification, or I would almost expect people to interpret that their business kind of falls into an accepted category, because it was kind of general, the exceptions that they used.
Okay. Can you distill it down? Like, what does it mean in a nutshell then?
Okay, so what it means is that, so it's certainly not the end of the world, and there are ways around it. There's definitely ways around it, and I still think debt is going to be the preferred way to finance as much of an acquisition as possible. What it simply means is that whereas before there was an unlimited amount of interest that you can deduct for any business interest expense that you had, now there's a limitation. But what it means, Sonia, is the key is you have to be more creative, you have to be more clever, and you have to plan ahead a little bit more. So I think a lot of companies just were always thinking, well, I'm going to take out a loan because I can deduct the interest expense.
Right.
Now you have to resort to some additional creative steps, and you have to be a little bit more clever. And let me say, I have an accounting background, I have a CPA background, but I am not a tax advisor, so we're not providing tax advice specifically to the Attract Capital viewing audience today. We're just giving you food for thought. We're giving people ideas.
Right.
I think what it all means, Sonia, is I think what the writers of the tax plan, what they were trying to do is they were trying to make sure, because they reduced taxes, corporate taxes down to 21%, they wanted to make sure that companies didn't say, yippee yahoo, we have all this extra money now that we're saving, let's go out and borrow more. Let's go borrow more and create more interest deductibility. So I think what the change was trying to do was trying to moderate the fact that corporations now are going to have more income because they're paying less in taxes. And they didn't want these companies to go out and lever up, because if they levered up, it might have been even more debt. So what they did is they went in the other direction. They said it can only be 30%. It will mean that companies that do have, like existing companies that do have debt on their balance sheets, are going to have to really work with this and look at it and say, you know, how can we, what are the levers available to us to pull so that we can manage down the level of interest expense that we have, so that we don't end up paying more in taxes.
Okay, so over the long term, what do you think this is going to mean for middle market companies in general, do you see?
I don't think it's going to mean a tremendous amount for middle market companies over the long term. I think middle market companies are very effective at trying to keep their interest expense down. I do think for buyouts, for private equity-led buyouts, they will be more creative and they might put more preferred equity. I think preferred equity might be used more frequently than perhaps junior debt pieces for very high multiple deals. So if you have a low multiple deal, let's say you have a 3 times EBITDA or 3.5, 4 times deal, you probably can fit within the 30% limitation. But if you have a 4.5, 5, 5.5 times debt deal, you're probably going to look a little bit more to preferred stock. I also think that people are probably just going to become a little bit more equity oriented and a little bit more creative. I think creativity is the key for middle market companies to navigate this. And I think one of the things about being creative is you have to look at one of the things that the definition gives you is interest income. It gives you the ability to offset your interest income from your interest expense when calculating that 30%. There are ways that I know of that companies can generate interest income if they set up a holding company and an operating company structure.
Okay.
And the holding company holds the loan, and they downstream the proceeds of the loan to the operating company. And the operating company actually has an obligation on their books to pay back the holding company, so they can pay interest over to the holding company, which is interest income, which would offset interest expense. So there's a way through setting up stacked entities, which is maybe an unusual sounding word or an unusual sounding.
No, it makes sense.
So you have one company up here with the loan, one company down here with an obligation, and interest income comes up to the higher company, and there's a way to offset it. So that's one way to do it. The other way to...
I have a stupid question.
Sure.
It could be a stupid question, but I'm going to ask it anyway. A DBA, would that kind of fall under the stacked category, or does it have to be like an LLC or an SCorp underneath the holding company in order to do what you had just suggested?
Well, Sonia, that is a great observation. It can't be a DBA because it has to be another legal entity.
Okay.
But what's happening now is because the tax code has changed, it used to be that LLCs and SCorps were preferred because they were flow-through, but now C-Corp rates are a lot lower. So what you're going to see is a lot of SCorps are actually... companies that are S-Corps may become C-Corps, or companies that are S-Corps may suddenly become subsidiaries of wholly owned C-Corps where they weren't before, because there's advantages of having an S-Corp. And one of the advantages is, you touched on a really great point, S-Corps can write off preferred stock. If somebody holds preferred stock, a distribution to a preferred stock holder is tax deductible to an LLC or to an S-Corp. So in some ways, what a lot of the experts are saying is that preferred stock can take the place of loans in an LLC or an S-Corp, and it'll equalize because you're going to get the tax benefit just as if you would have gotten the interest write-off benefit. So preferred stock, converting some debt into preferred stock will help you get around this as well.
So if you're a small business owner, is it more beneficial to be an S-Corp or an LLC versus, are we talking strictly middle market here when you say that there's an advantage to being
That's a can of worms. That's a really good question, Sonia. It's a bit of a murky subject right now because corporations were extended the 21% new rate, which is a huge reduction from the 35% rate that they were at previously. So corporations won really big in the tax reform. Flow-throughs did not win as clearly as C-Corps, because within flow-through, when I say flow-throughs, I mean S-Corps, LLCs, and partnerships. Some of them can get the benefit of the 21%. Some of them can't. Some of them are in this category called disfavored types of flow-throughs, which would include doctors, which would include lawyers, which would include financial advisors, which would include any type of flow-through where skill or reputation is the prime asset of the firm.
That's interesting.
So it's really weird. It's really weird. So the thing is that...
But isn't that with most companies, though, Dave? I mean, couldn't you say that most companies' skill and reputation? I
completely agree with you, Sonia. This is why you're making such great points. And what's really interesting about these flow-throughs is that what is tax advantage within flow-throughs are like real estate-oriented companies. So if you own a building, you get the benefit of the 21%. So real estate partnerships, real estate LLCs. So there's almost a recurring theme through this limitation on interest and sort of the entities that were favored to what really benefited were hard asset-oriented businesses. So for example, back to the exceptions we talked about before, real property, loans against real property are fully tax deductible, okay? LLCs and S-Corps that hold real property, that manage real property, get the benefit of the 21%. So there's certain themes that the tax reform is trying to address, but the S-Corp and the LLC it's a bit of a mishmash right now. And you have a lot of people that are looking at, how do I get the benefit of the 21%? You do get 21% up to a certain income level. So if you have, I mean, not to get too techie here, but if there's $315,000 of adjustable gross income, you get 21%. But long story short, the decision, you're going to see a lot more layering. You're going to see LLCs and S-Corps, and you're going to see C-Corps sitting on top of it. Getting back to the tax shield, the ways to preserve the tax shield that I see, okay, creative use of preferred stock,
Okay.
because you can distribute your income within LLCs and SCorps, and it's a tax write-off, and it's the same thing as getting full deductibility of your interest. That's number one. Number two is most lenders don't care if you're paying them interest or if you're paying them for some other reason. There's lots of other reasons you can be paying your lender. You can be paying your lender asset management fees. You can be paying your lender management fees. You could be paying your lender exit fees,
Right.
or a fee upon the refinancing. You could even pay your lender, if it's a mezzanine lender, you can go to them and say, listen, we don't want to pay you this level of interest rate. We'd like to pay you a lower rate, but we'll give you a warrant, or we'll give you some upside in exchange. So there's ways to, I think, recharacterize or to basically reshape the things that you're paying your lender for, so you can get within the limitation on the interest expense.
Okay.
So I think use of more preferred stock,
Right.
opening up the things that you're paying your lender for, and then, as we talked about earlier, if you create this stacking concept and you look at increasing your interest income, what the law clearly says is that it's the interest expense net of interest income has to be below 30%. So you have to look at what are the legitimate legal ways to bring more interest income into your company. And there's probably, if you talk to your tax advisor, there's probably lots of different ways you can do that. And there might be some, you might have to look at your, and one of the other ones we thought about is we've seen a lot of loans over the years, Sonia, where you paid your lender a percentage royalty. So if you're paying them a percentage of a royalty, that is, again, not truly interest according to the letter of the law. So there's different things you can do creatively. We came up with, a half a dozen of them just studying this for a couple of days. And I know middle market company executives are very creative. They are very clever.
Yes, they are.
And they're looking to take their businesses ahead. The last thing you want to do if you're a middle market business is, let's say you had 50% interest to EBITDA, now you're at 30%. So you'd pay an extra 21% on that 20%, which could be a pretty big check. You probably don't want to do that.
Okay.
So it pays to be resourceful. Get a good tax advisor.
That's right. Thank you. So there is a silver lining to this.
There is a green lining to this,
A green
Sonia.
lining. That's right. So everybody, thank you so much for joining us. And we are looking forward to seeing you again next month when we have our webinar next month. Dave, do you know the topic offhand that you're going to be discussing next month?
I just got back from India, Sonia, so I'm a little jet lagged. I'm sorry to say that I don't, but it'll be a very interesting topic.
Yes.
Thank you, everybody, for watching.
Thank you so much.
If you have any questions, you can email me at dbarnett@attractcapital.com, and look forward to talking to you soon.
Bye-bye, everybody. Thank you.